Hi, I'm Max Dilendorf, a New York attorney and a real estate broker with over 20 years of experience helping foreign investors structure their U.S. real estate purchases. In today's video, I want to explain how foreign buyers use trusts to purchase real estate in New York and how doing so can help you to avoid U.S. estate taxes, protect family wealth, and plan across generations. Let's start with an example. As a non-U.S. resident, if you own U.S. real estate directly in your name or even through a U.S. limited liability company, you are entitled to $60,000 estate tax exemption. The rest is taxed at up to 40%. So if you own a $5 million condo and pass away without a proper planning, your family could be facing a tax bill of almost $2 million. That's a massive loss, and it's entirely avoidable. And this is where the trusts come in. A properly structured, irrevocable trust takes ownership of the property. Once the property is inside of the trust, it's no longer considered part of your U.S. taxable estate. The trust becomes a separate legal entity, and that's what shields the assets from the estate tax. But trusts don't offer just tax protection. They also provide a high level of privacy and discretion. In our experience, privacy is often just as important as tax efficiency, especially for individuals in the public eye, such as high-profile executives, celebrities, or athletes. Trust structures can help ensure that ownership remains confidential and out of public property records. Another key benefit, trusts can also be funded with digital assets, including Bitcoin and other cryptocurrencies, to facilitate purchase of Manhattan real estate. With proper structuring, a crypto can be transferred into the trust, converted to US dollars, and used to buy real estate while maintaining legal and tax compliance. This makes trusts a highly effective vehicle for crypto investors seeking privacy, asset protection, and tax efficiency when entering the U.S. real estate market. As the grantor or creator of the trust, you have the power to appoint both the trustee and the trust protector. These roles are critical to the trust's success. The trustee manages the trust's operations and assets, including real estate. The protector oversees the trustee, can step in if needed, and has the authority to remove or replace them. Think of the protector as your oversight, someone who ensures that everything stays in line with your wishes over time. It's common to appoint a family member as a protector, a spouse, sibling, or an adult child, and legally that's totally acceptable. It's done both in US and offshore trusts all the time. But you have to be careful, because from U.S. tax perspective, independence is critical. If the protector or trustee is too closely tied to you or appears to be under your control, the IRS may argue that the trust is not truly independent and they can pull the assets back into your taxable estate. This is why we always recommend appointing a professional trustee company, especially when you are dealing with high-value U.S. real estate. A licensed independent trustee helps to ensure that the IRS can challenge the trust validity or claim is just a formality. It gives the structure credibility and minimizes risks. In the next video, I'll walk you through how these trusts are managed, how long they take to set up, and whether you should consider a U.S. trust or an offshore trust, depending on your situation. Thanks for watching. Subscribe to the channel for more strategies and insights on how foreign investors can protect their real estate investments in New York, and I will see you in the next episode.